Hello, this is a walkthrough video of the second AAT sample assessment for the new personal tax unit under the Q2022 syllabus. So let me share my screen. Let's go to the assessment and here we go. Okay, task 1, 10 marks. The only written task about the principles and rules underpinning tax. When I say the only written task, I mean the only one where you actually have to type. There are two other human marked tasks, one that requires you to do an income tax computation and one that requires you to work out the capital gain on the sale of some shares. But this one, define the terms residence and domicile. So you should have some information on residence and domicile in your reference material. So residence here. So it tells you are automatically resident if these things apply, automatically not resident if these things apply. Quite a lot of specifics there. And you've also got in that reference information deemed domicile reference information. That doesn't really help us hugely with this task. So for 2 marks, define the terms residence and domicile. So there's only going to be 1 mark for each one. So I would probably be saying something like residence, so UK residence means that an individual has been based in the UK for the current tax year. UK domicile means that an individual has the UK as their country of origin. Don't think we're going to need to go into too much extra detail. If you had plenty of spare time, you might be able to use some of that reference information as well. But for 2 marks, I think that is going to be sufficient. State how the residence status of an individual affects their chargeability to UK tax. Again, it's only 2 marks. It's only asking about the residence status. So I think here we need to make it clear that if an individual is both UK resident and domicile, then all of their worldwide income and gains will be chargeable to tax in the UK. If an individual is UK resident but non-UK domicile, then they can choose whether to tax the non-UK income on the remittance basis. I googled this just before I came on the video, so you might be thinking, well, what is the remittance basis? So you can see here, you pay UK tax on UK income and gains for the tax year in which they arise, but you only pay UK tax on foreign income and foreign gains if and when they are brought to the UK. Right, so you have that choice if you are UK resident but non-UK domicile. So again, I mean, you could explain that further, but it's only 2 marks. So as long as you kind of show the examiner that you understand there's a difference, then I think that's going to be sufficient. If an individual is not UK resident, then they will pay tax on UK income. Again, feel free to check the suggested answer, but I think that will suffice. 2 marks. Right, then for 6 marks, you work in a small accounting practice and your manager has noticed that there has been an increase in clients trying to claim private expenses as if they were business expenses. Your manager would like to start preparing notes for communication to all clients that clearly explains the difference between tax planning, tax avoidance, and tax evasion. So let's just think about this example they've given us. Clients trying to claim private expenses as if they were business expenses. So why would a client want to do that? Well, of course, if they're running a limited company or indeed a sole trader, doesn't really matter. Having extra business expenses will reduce their profit. Less profit means you are going to pay less tax. So that would be an example of tax evasion, which is illegal. So in fact, we could use that as our one example of tax evasion when we get to it. So 6 marks here. So we've got to define and give an example. So that's going to be the 2 marks. So if we say tax planning, so this is legal and it's where so hang on, preparing notes for communication to clients. So this is legal and is where a client uses the tax rules as the government intended to reduce their tax burden. For example, encouraged to make pension contributions by obtaining tax relief. That's just one example. Tax planning, it might be charitable giving would be another. It could be using savings accounts, using your ISA, using sort of looking at how your income is distributed to sort of make sure that you're paying the least amount. Things like that will be acceptable as tax planning. Tax avoidance, so this is technically legal, but is morally questionable. So these are the things you hear about in the news where, you know, your big names have got accounts offshore, or maybe they're employing fictitious people to work in their organisations, paying them a wage so that, you know, you're getting more use of people's personal allowances and lower rates of tax. Used to see it a lot. You know, you had a person running a business and then their spouse, nothing to do with the business really, would be getting a wage from that business, reducing the tax burden of the business and also meaning that they were using up personal allowances and lower rates of tax when really it was the other person's money. So technically legal, but morally questionable. So for example, what should we say as an example there? Having a head office in another country, which pays a lower rate of tax. Well, without mentioning any names in the answer, but Amazon would be a good example of that, have their head office in Luxembourg. So then we come on to tax evasion. Oops. Tax evasion. So this is illegal and unethical. For example, the situation where a client is putting personal expenses through their business to reduce their tax burden. Right, so 2 marks for each of those should be sufficient. 10 minutes in, that's about right. That's about how long I'd want to spend on that question, roughly 1 minute a mark, to allow a bit of time for sort of checking answers and such. So task 2, about income from employment, quite a challenging task, combining company car tax, accommodation, beneficial loans, all the exemptions, etc., etc. So Mr. P had the use of a company car during the tax year. All necessary information in respect of the car is detailed below. So 6 months he had it. It was registered after April 2020, so we don't have to add the 1%. It's petrol. Don't be fooled by the cost price. It's the list price we're interested in. There's been a contribution towards the cost of the car that's under £5,000, so that can all be subtracted from the list price. Contribution for the use of the car is £50 per month. Don't forget you only had it for 6 months. Private fuel provided by the employer. Yes, so we're going to have a fuel benefit as well. Doesn't tell us, or maybe it does. Oh, here we are. Employee contribution for part of the cost of the private fuel. So we have to know that that's that odd rule where it's just tough. So we basically ignore that. We don't subtract it, whereas we do subtract the employee contribution for the use of the car. So complete the following table. So the percentage, first of all. So the percentage is going to be round down the CO2 emissions to the nearest 5. So round down, so that would be 100. Subtract 55 and divide by 5. Then add 15. Don't need to add 4, it's not diesel. Don't need to add 1, it's a new registration. So that gives me a percentage of 24. The taxable benefit on the provision of the car. So we take that 24%, we times it by the list price minus the 3,200. All right, so work out what 20,750 minus 3,200 is. Then work out 24% of that. Then half it, because you only had it for 6 months of the year. And then subtract the employee contribution for the running of the car. So 50 times 6. And all of that should give you an answer of 1806. Taxable benefit on the provision of the fuel. So for fuel, we just have the reference number. So car fuel benefit. Quite easy to use this reference material, I think. So we've got the same percentage, 24% of 24,600, and then half it because we only had it for 6 months of the year. And then remember, we do not subtract the contribution. So 24% of 24,600 halved gives us 2,952. Incidentally, if the employee contributed in full towards the cost of the fuel, then there would no longer be any benefit for the fuel. So it's all or nothing with the fuel. Miss G had the sole use of a company van for the whole of 21-22. The van is an electric petrol hybrid and emits 50 grams per kilometre of CO2 when driven. There is 60% private use, so there's some private use. Incidentally, it doesn't come up in this question, but of course, home to office or home to the workplace in a car counts as private use, but in a van, it doesn't. So just watch out for that as well. But anyway, let's have a look at what we need here. So I'm going to find the van benefit. So we have got a basic charge of 3,500. We've got a fuel charge of 669, and it's only for 0 emission vans that it goes to nil. This is not a zero emission van, so we're just going to pick up those figures, do nothing else with them. So 3,500 and 669. Below is a list of benefits that S Limited provides to its employees. Enter the amount that would be taxable for each benefit, whole pounds, zero. Where appropriate, the averaging method should be used. That would be for a beneficial loan. So let's see if that comes up. So the first one, Mr. F was given the use of a company house for all of 21-22. It is job-related accommodation. So job-related accommodation is an exempt benefit. However, if there are any costs of running the property, known as ancillary services, then they are taxed as a benefit at the lower of what it actually costs the employer, so 4,700, and 10% of the person's earnings. So Mr. F is getting 38,500. So 10% of that will be 3,850, which is of course lower. So that will be the taxable amount. Just having a quick look in the reference material to show you other benefits. We've got that 75,000 there. Job related, here we are, living expenses. It tells us that that's restricted to 10% of the net earnings. Miss W received £10 per night in incidental expenses for 5 consecutive nights when working away from home in the UK. UK, you're only allowed £5. It's overseas, you're allowed £10. And you have to have the knowledge here. There's a few funny rules around this. If you exceed the amount, then the whole lot becomes taxable. So she's away for 5 nights at £10, so therefore £50. She will be taxed on that. The other rule here is that you need to look at it cumulatively. So although it's £5 per night, if for example it said £4 the first night, £6 the next night, and then £5 the other 3 nights, that too would be okay because it would work out at an average of £5 per night. Okay, next question. Ms. R had the use of 2 mobiles. Right, instantly I'm thinking, well, you're only allowed 1. Both were mainly used for business purposes and cost £50 per month each. So one of them is exempt, the other one is going to be a taxable benefit. £50 times 12 is 600, would be taxed on. Mr. C received 2 interest-free loans, 7,000 in January 2021 and 8,000 in November 2021. Nothing's been repaid. Right, so the key here is as soon as you go over 10,000 combined at any point in the tax year, so we started the tax year in April with 7,000 and then that's gone up to 15,000 in November during our tax year. So the fact it's gone over 10,000 triggers us having to tax it. We then need to work out what the average amount of the loan is, because remember it said that you use the average method where applicable. So it starts at 7,000, it ends at 15,000. So the average of those 2 figures, you could add them together and divide by 2, or you could just look at them and go, well, in the middle is 11,000. And then we times that by the official rate of interest, which is given as 2%. Which gives us an answer of 220. True or false? A fully electric car which has no CO2 emissions would be exempt. So let's look at our reference material. car benefit. So it said a fully electric car, fully electric with no CO2 emissions, so nil here, has still got a percentage of 1%. So it's not fully exempt. So that is false. An asset bought by an employer for the private use of an employee would not be a taxable benefit if the asset cost less than 10,000. Well, that's false as well, because the rule around using a company asset is it's 20% of the value of the asset when first provided for use. No mention of 10,000. The 10,000 applies to loans, not to use of assets. Free use of sporting facilities provided by an employer would not be a taxable benefit if the facilities are available to all employees and are not open to the general public. Now, I'm thinking that is true, but I'm just going to check if there's anything about it in my reference material. So anything about use of sport, here we are, provision of workplace sports facilities. That would seem to tick that box, so that is going to be true. Task 3, 10 marks. This task is about income from investment and property. Complete the following sentences. Whole pounds, enter 0 if required. Miss W received a dividend of 4,500. Her other taxable income after personal allowances totalled 42,400. We've got to work out the tax payable on the dividend. Right, so she's already in the higher rate bracket here. So we know the first 2,000 of the dividend has the dividend allowance, so nothing to pay on that. That will leave her with 2,500 at the higher rate. Remember the higher rate for dividends, 32.5%. So 2,500 times 32.5% gives us an answer of 813. Mr. F received 5,200 in interest from his building society account and 720 in interest from his ISA. In his other taxable income is 34,780. They're being nice, telling us it's after personal allowances, because the phrase taxable income means it's after personal allowances. Now, I found this question quite tricky. I think this was the one I actually got this wrong when I did it, and I checked the answer. So see if you think it's tricky too. So first of all, Mr. F said we know that the ISA is exempt. So we're only interested in this 5,200. His other taxable income is 34,780. That was after personal allowances. And then if we add on the 5,200, we can see that he becomes a higher rate taxpayer. So that means that he would have a savings allowance of £500. So this bit's not too bad. His income from investment on which the tax will be paid will be the 5,200, subtract the 500, which is 4,700. We're then asked, what's the total tax payable on this interest? Right, now what we've got to be careful of here is, because we're going to hit the change between basic rate and higher rate with our savings interest, we've got to be careful that we remember to add on the 500 that's taxed effectively at 0% for the savings allowance. This is the bit I didn't do. Right, so we have to say, right, the first 500 is taxed at 0%. And then we work out how much is going to be taxed at 20%. So we need to do 37,700, which is the basic rate tax band, minus the 34,780 that's been taxed non-savings income, minus the 500 that's had the savings allowance applied. So that gives you a figure of 2,420 that is taxed at the 20% level. And that gives you a figure of tax of £484. You then need to figure out how much is taxed at the higher rate. So you're trying to tax 4,700 altogether. We've already taxed 2,420, so let's subtract that, which means that we've got £2,280 left to tax at the higher rate of 40%. So 2,280 times 40% gives us 912. So I've got that 912, add it to the 484 at the basic rate, and my overall answer here is 1396. As I say, I think that's quite challenging. I got it wrong. I was just taxing the 4,700 on top of this figure. I forgot about the 500 at 0%, which is obviously going to shift a bit more of it up into the higher rate band. Mr. X owns and rents out 2 properties during 21-22. Complete the table, whole pounds, 0. Right, Windy Walk was let for the whole of 21-22 for 1,070 per month. So if it's the whole year, we just do 1,070 times 12. Paying 10% commission, so that would be 1,284. Is this allowable, 4,200 for an extension? No, it's not, because that's not revenue expenditure. And we're dealing here with income tax, not to be confused with our capital expenditure when we work out our capital gains in the later part of the exam. So our expenses are just 1,284, the 10%. Cold cottages let from the 1st of November 21 for the remainder of the tax year. Rent paid on the 1st. So remember, we do this on the cash basis. So 1st of November, December, January, February, March, April. So I've got 6 months at 670. Advertising, that's fine, as an allowable expense. True or false? Landlords can claim insurance paid on a rented property as an allowable expense. Yes, insurance is a revenue expense, so that is fine. The cost of improving a property prior to renting it out would never be an allowable expense. Right, this is a bit slightly tricky. So if you bought a dilapidated property at a cheap price and then spent a fortune renovating it to bring it to a livable standard, then I think arguably you got it at a cheap price, and really your cost of renovating was part of the capital expenditure. However, if you've got a property and maybe it's been empty for a while, or maybe the previous tenants sort of trashed it a little bit or something like that, then, you know, there might be some redecoration, there might be some repairs that need doing, which are an improvement to the property, and they would be allowable. So therefore we have to say it's not a case that they will never be an allowable expense. So that one is going to be false. Task 4, income tax payable. So this is the human marked question with the 4 columns. In this example, we have to do 2 income tax computations, one for Mr. and one for Mrs. K. So I'm going to use the approach that I showed you in the last video for the first AAT sample assessment, where we don't have columns for NSI, SI, DI, but instead we kind of use them to show our detailed workings. So starting with Mr. K, he has trading income from employment, self-employment of 48,780. Let's have a little look. He's also got property income. He's got some rental property losses brought forward that we'll have to subtract from the property income. He's got some building society interest and he's got some dividends. Mr. K paid money into a private pension scheme. So remember, that's his net. So he'll be paying 1,200. We'll have to gross that up, and then possibly that will affect his personal allowance and his tax bands. Mrs. K has paid some PAYE, but that's it for her. So trading income will be the full amount. There's no adjustments to make there. He's then got his property income. So if we just go back up, we could open this on the references, but to be honest, I find it easier just to go up and down. So we've got 12650 minus 8450. So we'll show that in a working. So 12650 minus the 8450. You could even add what they were. You can do whatever you want on this because it's human marked, as long as you explain what you've done. So that gives us 4,200. We've then got the building society interest of 920. So we've got to think about whether there's any savings allowance to be had. And then he's got some dividends, 2630. So we know 2,000 of that will be taxed at 0%. So let's total up our net income for Mr. K. So if we add up all of those four figures, we get 56,530. Right, so he is a higher rate taxpayer. So I'm already thinking he's going to have £500 of savings allowance, but he's not high enough to have to worry about adjusting his personal allowance. So we can show that the 12,570 will be deducted to give him a taxable income figure of 43,960. Right, so we know that he is a higher rate taxpayer. We also know that he made some pension contributions. So let's have a little work in here about his pension contributions. So the net was 12 times 100 that he was paying each month. Yeah, 12 times 100, which is 1,200 net. So if we do 1,200 divide by 80 and times 100, then that gives us the gross, which is 1,500 gross, which will raise the tax bands. So maybe just, I mean, it's fine. You can kind of do this however you want, but just making it clear to the examiner. So non-savings income. So that's going to be, let's just do a little working here for that. So non-savings income, remember we normally have this in a separate columns, but they haven't given us enough columns to do it like that. So it's going to be 4,870 plus 4,200 and then subtract the the personal allowance. Just aware that I've spaced that out too much. I'm not going to be able to see it, so just getting rid of some of those spaces. So our non-savings income then is, I think, is that coming to 40,410? So we are going to begin with our normal 37,700 at 20%. We've raised the bands by 1,500. We've got, even if I add 1,500 onto that, let's get my calculator, hold on. Right, so 37,700, add 1,500 is 39,200. So I'm still not up to my 4410 that I'm trying to tax. So let's put 1,500 at 20%, which is £300. And then we can work out how much we've got left to do. So 4140 minus the 37,700 minus the 1,500 equals 1,210. Is that correct? Let's just check. Yeah, so we've got 1,210 left that we're going to do at 40%. So that gives us a figure of 484. Right, then we come to our savings income. So we know that he's a higher rate taxpayer. So the first 500 will be at 0%. Savings allowance, and you can use this other higher rate taxpayer. So that will be 0. How much savings has he got left? So if we go back up here, 920. So we've got 920 minus the 500 gives us 420. That's going to be taxed at the 40%. We're currently in that bracket. So that gives me 168. We've then got our dividend income, where we know the first 2,000 is at 0. So that will be 0. And then that leaves us with, so we have 2,630 to do. So 2,630 minus the 2,000 equals 630. Watch out for dividends, higher rate, 32.5%. You can always check that in the reference material if you wish. So we've got all the components there. Add them all up. Label it tax liability. If you were to look at their suggested answer, it might not look exactly the same, but you've got to find a way that works for you with these questions. Right, moving on to Mrs. K. So I think hers is a bit more straightforward. She's just got the PAYE. She hasn't got any adjustments to the figures. So she's got income from employment, 26,780. So employment income, 26,780. She then had some property income, £12,650. And then she had some building society interest. That was 1,090. And then she had some dividends of 3,870. Right, so net income, remember net income means total income, comes to 44,390. certainly not over the 100, so subtract the personal allowance, gives Mrs. K taxable income of 31,820. Right, so she is a basic rate taxpayer. So she's going to have £1,000 savings allowance. So non-savings income. Right, so we need to, let's work out what it is. So we've got 26780 plus 12650 minus 12570. So that comes to 26860. That's taxed at 20%, which is 5372. Savings income. So we've established that she's a basic rate taxpayer. So the first £1,000 will be at 0, and then that leaves us with 90 at 40%. 20%. Just checking. Basic rate taxpayer, right? So that comes to 18. Right, then we've got her dividend income. So we know the first 2,000 is at 0%. Nothing to pay there. Her dividends are 3,870. Basic rate for dividends, 7.5%, 140. So her tax liability is all of these added together. We were told that she had some PAYE deducted at source of 2,800. So her tax payable will be 2,730. Time consuming, but 14 marks. Probably worth scribbling it out on a piece of paper first, but please make sure you practice typing it onto this 4-column situation, maybe even getting some other questions and using the 4 columns in this exam to kind of really get used to how you're going to lay it out. So that brings us to task 5, which is on national insurance. So it seems to be quite straightforward national insurance questions in terms of the calculations, especially when you've got this reference material. Okay, so let's just move that there. Right, so Mrs. E, 18,700. So she's in this middle band, so we do 18,700, subtract the 9,568. That gives you 9,132. And then you find 12% of that figure, which is 1096. Mr. U has got 52,580. So his is a bit more tricky. So we have to find the difference between these two numbers, the 50,270 and the 9,568. So that is 40,702. We work out 12% of that figure, which is 4,884. And then we just do 2% of the excess. So 52,580 minus the 52,700, and then 2% of that. All right, so that gives you 46. Add that on to the 4,884. And the answer for Mr. U is 4930. Class 1 payable by Mr. O. Right, so who's Mr. O? He must be the employer. He's a sole trader. He employs 2 people. So he's going to have the £4,000 allowance. So what we're going to do here is we are going to work out the employer contribution for these 2 workers. So here we are, the employer. So everything over 8840 at 13.8%. Right, so we've got 9860 for Mrs. E. We've got 43,740 for Mr. U. Both of those at 13.8% gives a total of 7397. We know that the allowance is 4,000, so we subtract 4,000 to give us an answer of 3397. The total employer class 1A, so that's on the benefits, 13.8% on all benefits, which are 3880. So 13.8% of that is 535. A bit of a tax planning thing there, isn't it? If you're an employee, you don't pay national insurance on the benefits, but the employer has to pay it on the full lot. So let's close that for a moment. Identify whether the following statement about national insurance contributions is true or false. National insurance contributions are calculated on an employee's gross salary before the deduction of pension contributions. Yes. Oh, that's it. Okay, on to task 6 now. This is the last one I'm going to do on this video, and then I will do a separate one for the capital gains and inheritance tax. So task 6, tax planning. So Mrs. E received employment income, 58,780, building society interest, dividends, and a loan of £9,000 from her employer on which she pays no interest. So it's under 10,000, so it will be exempt. Identify the effect on Mrs. E's income tax liability if she had made each of the following changes. Assume that each of the changes is the only change made. Right. So Mrs. E placed some of her money from the building society into her first ISA. The interest received on both accounts would be the same. Right, so she's clearly a higher rate taxpayer, so she would have had £500 of savings allowance. Even if she'd been a basic rate taxpayer, some of this would still be taxed, because even then she would only have had £1,000 that was taxed, that was at 0%. So it's going to be tax efficient for her to move some of this into an ISA, because we know that the interest there is exempt. So therefore, if she does that first thing, she is going to decrease her income tax liability. Second one, if she sold her shares. Right, if she sold her shares, she wouldn't have the dividend. But she's not being taxed on the dividend anyway, because everyone gets the £2,000 allowance. So it won't make any difference to her tax liability. She'll lose out on the dividends, but no impact on her income tax liability. Mrs. E increased the loan by £2,000. Right, so if the loan went up to 11,000, then the whole thing, all the interest that she's saving would then become a taxable benefit. So that will increase her tax burden if she were to do that. if she paid 1% interest on the loan, so remember it's in isolation, so if she's got £9,000, it's an exempt benefit anyway, so it doesn't make any difference if she pays no interest or a small amount of interest, it remains exempt. So that one will have no impact. Right, part B. Whole pounds into zero. Mrs. E decided to join the occupation pension scheme operated by her employer. She joined on the 6th of April 21, start the tax year, and she pays 9% of her salary into this scheme. Right, so when someone pays salary in, that reduces their employment income. And then you're obviously taxed on that lower amount. Her employer pays, mark on my screen, can't think numbers, there we go. Her employer pays 12% of her salary into this scheme. That's an exempt benefit. Mrs. E will save how much in income tax if she joins this scheme? Right, so this is Mrs. E. It's all part of the same question. So Mrs. E's got employment income of 58,780. I'm just looking at my workings because I found this one quite tricky as well. So if she puts 9% in, 9% of that figure is 5,290. Right, so that would be subtracted from her employment income figure. So now her employment income is 53,490. She's still a higher rate taxpayer. So therefore, she will save 5,290, which is the amount we're subtracting, at 40%. So that works out at 2,116. Actually, it wasn't that one, it was nasty. It wasn't too bad, was it? Right, this one. Mrs. E receives 50p per mile from her employer when using her own car for business purposes. She's going to do 12,000 miles. Right, so 12,000 times 50p means she's going to get £6,000. Mrs. E has been informed that from April 21, she's only going to get 40p per mile. How much will she save in tax through this reduction? So she's not better off, but she will save some tax. Right, so at the moment, she's getting £6,000. Let's figure out how much she's entitled to. So she should be getting 10,000 at 45p and 2,000 at 25p. So that gives a total of 5,000. So she's £1,000 over. So she will be, as a higher rate taxpayer, remember it's still Mrs. E, we know she's a higher rate taxpayer. So she will be being taxed at 40% on that extra £1,000 that she's receiving, which is £400. Right. So hold that thought. She's at the moment she's being taxed £400. If it goes down to 40p a mile, so 40p times 12,000, that means that she should be getting 4,000. Sorry, that means that she would be getting 4,800. Right, so we've worked out she should be getting 5,000, and now she'll only be getting 4,800. So that means that she'll have an allowable expense of 200 because she's not quite getting enough. She's paying that out of her own pocket. So 40% of that allowable expense, 40% of 200, is a further £80 that she will be saving. So the overall answer here is 480. Right, so I'm going to pause there and do the rest of this in a separate video.